overview of Vermont's tax system. Really appreciate you being here to give some thought to how maybe your own policy area and committee applies to the work that we do in Ways and Means, and so that we can all have a shared language as we look at revenue and tax issues throughout the session. So thanks again for coming here. There'll be recordings of all of the presentations on the Ways and Means website, right on the Ways and Means landing page on the left. And for today's presentations and the other presentations, all materials for these workshops are also available on the Ways and Means website. They're not going to be available on paper. We're going to go through the full each presenter's presentation and then do Q&A. So please, if you have a question, jot it down, save it, promise to get to it. I want to, before I turn it over, just express such gratitude for Abby from Legislative Council and Emily Byrne from JFO for really spending some serious time this December. We do these presentations regularly, but they really dove in to revamp them and update them for everyone. So thank you very much for your work on this, and thanks all for coming.
All right, good to see everybody. I'm Emily Byrne. I'm an associate fiscal officer with the Joint Fiscal Office. I've been in the office for about I started the end of August, so not quite 6 months. I will call out on the back row, there's a bunch of other fiscal analysts from the Joint Fiscal Office, so I may call on them if I need help with some things, or if there are specific questions that I can't answer, we'll call on them to help. So I'm going to start with just sort of high level general principles of a high quality tax system. I got a similar type presentation when I was in public administration school. And this is sort of generally big picture things to think about when you're structuring taxes and how to put together a good system. And then after me, Abby from Leg Council will dive into the anatomy of a tax, which will go more into sort of taxonomy of tax language. And how we talk about taxes. So I will jump right in. So there are 6 principles that we usually talk about when we think about a high quality tax system. And I will go through all 6 of those. Before I dive into the principles themselves, just to clarify, I did not make them up. They are sort of known policy framework for tax policy systems. You can read, if you're really interested in diving into the details of each of these principles, the NCSL Tax Policy Handbook for state legislators. It was put out, the 3rd edition was put out in 2010. It kind of dives into the details of each of these principles, but I'm really going to touch on them at a high level. So we'll go from there. So there are 6 principles again. The first one, sustainability, reliability, fairness, simplicity, economic competitiveness, tax neutrality, and accountability. The first one we'll talk about is sustainability and reliability. So what does that mean when we're talking about a tax policy? It means that the funds are reliable, meaning they're not one-time in nature. Government provides services to people every year. A lot of things sort of stay the same every year. We want to make sure that the revenue that helps to provide those services is predictable on an annual basis. We sort of can rely on that money coming in every year, and there's not going to be major changes to the base year over year or major changes to the rate year over year. So from a state perspective, the corporate and the personal income tax, sometimes we think about as slightly more volatile than some of the other tax types. That being because it's more tied to what's going on in the economy and the labor market. And so as economic conditions, sometimes the taxes that are coming in from those sources can change. Similar, on the other flip side, the sales tax tends to be more stable. People sort of continue to buy the same stuff every year, and we can kind of count on that revenue being somewhat stable. From a taxpayer perspective, similarly, if what was subject to certain taxes was changing on an annual basis, or the rate was changing on an annual basis, it would be really hard to plan, how much of my income is going to be paid in income taxes every year. What does that mean for my expendable income? Similarly, I want to know when I go to the store what the tax rate is going to be, and that, to be predictable. Related to that is this idea of sustainability, right? That it isn't one time in nature. A lot of times when we talk about state revenue and expenditures, the idea of one-time funds comes up, meaning that we don't want to rely on services that we're going to provide to Vermonters on an annual basis on a revenue stream that's only going to come in once, right? Or that we don't know if it's going to come in year over year. So thinking about making sure that the tax policy that gets adopted has that sort of consistent revenue stream year over year. Similarly, that we have a diverse tax base, right? You don't want to put all your eggs in one basket from a tax perspective. So if we have a tax base that's broad enough to mitigate volatilities in each individual tax type, we can kind of make sure that we've got enough revenue coming into the state to provide all those services to Vermonters. And our goal is really to have a balanced mix of taxes. So just to give a high-level picture of what does Vermont's tax system look like today, this is based on the revenue forecast that the Economist does every 6 months for the state. It is not comprehensive of all revenue that comes into the state. There is lots of other fees and some taxes that go into special funds. This is really just a summary of the pieces that are forecasted by the economists, with the exception of the property taxes. The property taxes are set sort of separately, but they're an important, very large component of the state revenue stream. So if you look at the chart, you can see that it's a third, basically, a third property taxes, a third income taxes, income being corporate and personal income taxes, and about a third consumption taxes, so sales taxes, rooms and meals taxes, et cetera, and some other fees and those sorts of things. So if you look at it sort of overall, we've got a pretty balanced between those three tax types. Whoops. Yeah, okay. So the second principle I'm going to talk about is fairness. Fairness meaning that we want sort of equality in who, or equity in how much people are paying in taxes based on their ability to pay. We sort of think, we break this down into equity in two sorts of ways. So there's horizontal equity and vertical equity. Horizontal equity is really the idea that two taxpayers in the same economic circumstances are paying the same taxes. So if you've got two couples, they both make $60,000 a year, are they paying the same amount in taxes on an annual basis? Kind of put that, asterisk onto it, like, okay, so but what if one of those couples has a mortgage? At the federal level, you're allowed to deduct your mortgage interest, right? So their tax liability is different based on them having a mortgage. The sort of question for policymakers in that space is, how does that sort of comport with this idea of fairness in the tax code? The other principle we talk about is vertical equity, or a lot of times that's talked about as progressivity. And that meaning that somebody who has more ability to pay pays more than somebody with less ability to pay. And sort of how that distribution of the tax burden moves across taxpayers in different economic circumstances. So I have a little made up example, right? You have a single person number A, and their income is $50,000. Their effective tax rate, for example, is 3%. And the other person B, has an income of 150 with a 6% tax rate. That would be a progressive tax, meaning that the person with higher income is paying a larger percentage of their income in taxes. And Abby will dive into effective tax rate in her presentation. This is just a little chart of what a progressive versus a regressive tax would look like. We've got the percentages of income on the bottom and just how much of their income is paid in taxes from there. The Institute for Taxation and Economic Policy, sometimes referred to as ITEP, did a study of all of the states to look at sort of how progressive or regressive state level tax codes are. And Vermont's state level tax code, they determined, does not worsen income inequality. It actually sort of shrinks it. So meaning the tax code that we have is progressive, and that the gap between lower and middle income taxpayers and the wealthy actually shrinks based on our taxpayers. So that's a reflection of the progressive tax code that we have. Vermont ranked 49 out of 51, 51 being the best in terms of how progressive the tax system was. And it looks at the whole tax system. So sometimes when we think about taxes, you can kind of get to a narrow view of like, is this specific tax progressive or regressive? But it's important to really think about that in the context of the entire tax system and whether or not, a specific tax may be progressive or regressive, but in terms of what does the impact on the whole system have? Because sometimes a progressive tax may not make perfect sense for reasons we'll get into. We'll just note this was published in 2018. There has been changes to the income tax code in Vermont and in other states. So whether or not we're still number 49, I'm not really sure. There'll be another report, I'm sure, in a couple of years. But based on 2018, we were doing pretty well. And this is just a chart from that report, broken down by income quintiles, almost quintiles. It just shows the total taxes paid by income amount. You can see that at the lowest end in total taxes, so income, sales, everything, paying 8.7. And then when we get all the way to the top 1%, paying 10% of their income in taxes. And that's sort of mostly progressive. There is a little bit of lumps in it, if you will, but generally progressive. And then this is just one other snapshot to show that progressivity, specifically in the Vermont income tax. The effective tax rate, so the average for all taxpayers in Vermont in 2020 was 3.67%. And you can see that on the x-axis, we have the federal AGI income brackets and the effective tax rates paid. You can see they go up as people's incomes rise in terms of a percentage of income paid. So the next principle I'll talk about is simplicity. So you don't want to have a tax system that's highly complicated for taxpayers to understand. You want it easy for people to pay their taxes. And you want, that sort of ensures that people can, end up actually complying with the tax system. It's easy to do that. Similarly, it makes sure that, if it's easy to administer, those who are potentially collecting taxes on behalf of people who are doing that work can raise that revenue for the state efficiently, effectively. And you want taxpayers to be informed on how things work. We'll get into a little bit of some of the tensions with simplicity and fairness. A lot of times what we see in the tax code is when policymakers are trying to make the tax code more fair, what ends up happening is it comes at the cost of simplicity in the tax code. And I think some may argue that one of the best examples of that is Vermont's property taxes. It's very complicated, but a lot of the complications that are in the property tax are done so to make it more fair for people and to make it more progressive. So there's that inherent tension in policymaking. I did this as a quick example of Vermont's personal income tax in terms of complexity. It's actually not crazy complex. Take your adjusted gross income from your federal form. There's a couple additions to your adjusted gross income, 3 sort of big buckets of subtractions, and you end up with your Vermont taxable income. Generally, that's actually not horribly complicated, right? There are credits after that happen, but there aren't, lots of different calculations that happen. Take your federal form, add this, subtract this, that's your Vermont taxable income. Another one of those principles is economic competitiveness. So you want a tax system that's responsive sort of to the economic circumstances and what's going on in other states and internationally. You want it to be, level playing field, devoid of high rates and compliance burdens, because what you don't want is people to tax shop to the extent you can discourage it. Meaning, are people going to move because property tax rates are too high? Are people making decisions about where they're shopping because there's no sales tax across the river? Those sorts of things. So thinking about those things in the tax code and what gets adopted and taking into account what other states are up to. So we did just a little comparison of personal income tax rates at the highest rate for married couples filing jointly in 2019. So you can see Vermont has a pretty, not the highest rate, but on a taxable income that's significantly lower than some of the other states. But so in playing with the income tax code, really looking at sort of how do you compare and what does this potentially mean for movement across state lines and how people are going to recognize their income. Did a similar analysis on state sales tax. And I sort of highlighted state because not every state's sales tax is only, Vermont's sales tax, most of it is at the state level, but there's also local option taxes. So not every town pays a 6% sales tax. Sometimes there's 7%. I grew up in upstate New York. I've never paid 4% sales tax ever in my life because there's lots of county and local taxes, sales taxes in New York. So there's just a flag that this is just the state level sales tax. There are sort of variations in sales tax at the local level. Similarly on meals, there is Vermont charges a 10% meals tax on alcohol. So it is a little bit different there, but just, if you look, we're not totally, we're in the ballpark of sort of where our neighbors are in terms of what they're charging for things. And when thinking about policy, sort of taking into account, will people behave differently if we change those rates? Will they decide to vacation elsewhere? Will they shop elsewhere, et cetera? Tax neutrality. So this one is the idea that we're trying to minimize unintended consequences of the tax system. Sometimes policymakers decide to actually use taxes as a means to make policy, right? We want to discourage people from smoking cigarettes, for example, or discourage people from driving too much. And so you increase the tax on gas, for example. But sometimes that's not the intent of the tax. And it's really important to sort of determine whether or not when you're making a tax policy decision, what behavior changes may occur. And is that the true outcome that we'd like to have from that policy? Is adding a tax to something going to change the way the decisions that people are making? Are they going to decide to invest in a certain resource versus something else, or live somewhere? Are businesses going to make different decisions because of the tax policy that's been adopted? And when policymakers do use the tax code to drive behavior changes, it really should be explicit. Everybody should know, we're going to raise this because we think too many people are smoking. We want, to reduce those rates. So we're going to ask people to pay more. And we should evaluate that, right? We should make sure that that's working and it's an effective use of achieving the ultimate policy goal. Can we wait till the end? Perfect. Just to make sure we get through everything. So in I think this is the last one, I haven't been keeping track, is accountability. So the tax system should include taxes that are explicit, right? Like you should know that you're paying a tax when you've been asked to pay a tax. It should be, we should evaluate regularly what our tax system is, again, similarly to the previous slide, to make sure it's in alignment with our intended policy goals. The Joint Fiscal Office every 2 years puts out a tax expenditure report, and the tax expense as a way to present to the legislature, you've exempted these things from the sales tax. This was the sort of goal of that. Are you achieving those goals through that tax policy decision? And similarly, does that policy sort of unfairly benefit certain taxpayers at the expense of others? Nope. Is it possible? So with all of those sort of big picture things in mind, right? Things to think about when you're making tax policy, is it possible to actually design a perfect tax system? It's important for policymakers to sort of think about what's most important of these big principles when designing the tax system, so that the taxes themselves kind of align with those principles. And there will be trade-offs, in terms of tax neutrality versus influencing behavior. When you're, is the decision to do a cigarette tax or the soda tax or a gas tax really influencing the behavior that's intended? Or is it actually driving people to just buy cigarettes in New Hampshire? It's sort of a question to think about. Or how far east is how far west does the line of people that are willing to make that drive move? based on the tax policy. And there are, those sort of tensions occur generally. I think if we could have designed a perfect system, there would be one, right? And weighing those costs and benefits of each of these principles is important. And the big one that comes up frequently, and I'll dive into a little bit more, is really the tension between simplicity and fairness. So whether or not you've got a tax code that is simple, that may become at the expense of fairness, and vice versa. So one of the things, that you sometimes think about, so the sales tax is often talked about as one of the more regressive taxes in the state because everybody pays 6%. And so how do you make the sales tax more progressive, meaning that lower income people tend to pay a higher percentage of their income in sales taxes because of the consumption that they're making. So how do you make that more progressive? It'd be very simple, right? If there was just a 6% sales tax on literally everything you bought, right? And then that was it. The idea of tying the sales tax to income is probably not a realistic outcome, right? The idea that you would have to tell a merchant what your income was as a way to make it more progressive is likely not something that we have the capacity to do, nor would people want to do that or merchants want to take that on, right? So we've got a seemingly regressive flat sales tax. But the legislature has adopted policies to try to deal with that, right? But that when you do that, you start to introduce those complexities in the policy. So right now the sales tax is 6%. It's regressive sort of in that it's blind in terms of people's ability to pay, right? We don't take that into account when someone goes to the store to buy things. So to try to account for that, there are sales tax exemptions. So are there things that maybe lower income people spend a larger percentage of their income on as a means to, if we exempt those from the sales tax, then we kind of reduce that sales tax burden because a higher percentage of folks' income is spent on those items. We can make it more progressive. So currently the Vermont sales tax code includes the exemption of medical supplies, groceries, newspapers, and this is not a comprehensive list. This is just a couple big things, and clothing, right? So these are items that the legislature has decided, you know what, there isn't going to be a sales tax on these items as a way to make this more progressive. But once you start to do that, in terms of introducing complexity into the system, you start to ask questions of, okay, so what is a grocery, right? And right now, candy is, right, Abby, correct me if I get this wrong. Right now, candy is considered grocery, so it's not subject to the sales tax. There has been conversation about, do we make candy subject to the sales tax? Then you get into the okay, so how do you define candy? The streamlined sales tax agreement, which Vermont is a part of, which is a way to sort of simplify the administration of taxes across states, says that if the item contains flour, it is not candy, which means that Kit Kats and Twix bars would not be considered candy and would not be subject to the sales tax, but M&Ms would be. So in this world where you've got, seemingly simple system, okay, we'll put candy in this, from an administrative perspective, starts to get complicated, right? And it's in this sort of policy of trying to achieve fairness and make this system more progressive, very quickly gets complicated, sort of at the expense of simplicity. It's sort of a cute example of that, but the what is a marshmallow? Is that a grocery or not? Is one of my favorite sort of tax policy questions. And you could debate that all day long. Anyway, I believe that gets me to the end of this. So yeah, just a high level, just sort of keeping those things in mind in terms of making tax policy, sort of how are these monetary decisions going to impact people's behavior, people's incomes, et cetera. And thinking about, what's the priority as a policymaker? Is it most important that we make sure people don't go across the border to purchase things? Or is it important that it's simple to implement? Or do we want to make it as fair as possible so that it's reflective of people's ability to pay throughout the system? And with that, I will go to questions. Yeah, go ahead.
I was just wondering, in your example around, I live in a border town. And what's happened over time is all of the grocery stores that used to be in the town of Hartford no longer exist. So the 10,000 residents that we serve in this body have to go across the river. And it's only 2 miles, which makes it very convenient, but still problematic, you know, in the sense of keeping, let's say, that tax revenue and potential sales revenue on this side of the river. I'm sorry, I leaned away, I'm sorry. Thank you. And I know that a lot of us, you know, have that problem, you know, as you go up and down the Connecticut River side. And then, you know, the folks on the New York side would probably have a similar situation that's happened over time. Where's the balance point, I guess?
That's a great question. And I don't want to punt it to the policymakers, but I think that's one of your ultimate questions while you're making these sort of tax policies is how do you think about where those people are going to go and how do the changes in Vermont's tax code going to impact that movement of people and goods and all that stuff? Yeah. Sure.
Thank you. My question is about I think the element of those 6 aspects that we hear most about is economic competitiveness. And we always hear Vermont tax rates are too high and people are moving out of state. But as you pointed out, I also grew up in upstate New York and never paid 4%. You know, so it's really hard to the figures themselves may individually be accurate, but cumulatively, it's hard to see a real true picture of tax burden or cost of living across all of those. Is there a simple mechanism, reliable mechanism for that?
I'm not sure if there's a simple, I think that ITEP report does a really good job sort of comparing lots of states and
I mean, as a corollary to that, I know at one point, the governor had said that, you know, 26,000 Vermonters moved to Florida over the course of 10 years, and it was because our income tax rate is too high in Florida. It doesn't have a personal income tax. But over the same time period, more than twice as many New Hampshire residents moved to Florida. So it's obviously not the personal income tax that's driving that flight. So we draw conclusions based on incomplete information. I don't know if there's a question there or just a comment, but thank you.
Yeah, no problem. Yeah.
Well, I'd like to pick up on that, Representative, because I know a lot of folks move out of the state because there is something online that you can go find, which I have not found, but my ex-in-laws reviewed, which are how many states it's the least expensive to retire within. And that had to do sometimes with their property tax burden. They were very well off. That was a $20,000 a year burden for them. So they moved to, North Carolina, and they pay $2,000 for the same size and comparable house. So that's 18 grand a year for one couple. That's pretty substantial. But that also boils down to my question, which was, besides property taxes, what are the other things that our aging population will see in looking to stay here in Vermont while they age? Because if we've got 55% of Vermonters are over the age of, well, I forget what the statistics are. We have a lot of aging Vermonters. So what will, from the tax perspective, keep them here or push them away from the current standpoint?
I don't know if I can answer that question. So I think, yeah, I don't know. People, it's hard to make general comments about people's individual decisions around whether or not it's the tax code, whether it's not, I'm sick of shoveling my driveway, right? Whether or not it's sort of, I want to be closer to grandkids, those sorts of things. So I don't know that that's necessarily a question I can answer. That's sort of a policy. Again, I hate to punt it back to all of you, but that's where some of your analysis and policymaking work will come in. You had one, right?
So I'm interested, if you can hear me, on the effect of taxes on behavior, and wondering if, and you made a really great point, you know, they're going to go to New Hampshire and buy their candy and cigarettes. Can you point me to any place that might actually have data on real behavior change based on tax, or is there just not any way to measure it in a reasonable way?
I'm not, I don't know if anything off the top of my head. Let me see if I can track something down. We can get back to you. Yes.
I noticed that diversity and diversification only appears in the sustainability and reliability section. And yet my experience teaches me that every tax has a different mix as between the qualities of a high quality tax system. And so for my money, diversity ought to belong also in the equity category, because each tax has a different, if you like, distributional effect, has a different accessibility, reliability, equity, all the rest of it. And I'm puzzled as to why diversity is only focused on the reliability of collections as opposed to the effect on individuals.
That's it. Yeah, that's an interesting point. I don't think I thought about that. Thanks. All right, I want to make sure Abby has enough time to do her stuff, but if you think of more questions, or should you do one more question? Okay.
It's a very simple question.
Yeah.
If someone has an options tax in their community, that's remitted to the state, and then the state sends the money back to the town, right? And what's the percentage?
I believe it's a 1% local option.
Right, but when it's collected, let's say that's $1 million and the state collects $1 million, don't they retain some
30%, Tasha.
30%? Thank you.
That's a good Abby question. All right, thank you. Oh.
Thank you. My name is Abby Shepard. I'm an attorney who handles primarily personal income tax and sales and use tax, most of the consumption taxes except for the gas tax. So I can't answer any questions about that. To answer a few of the questions, and I'm sorry, that's very loud. The discussion about purchasing outside of Vermont, for example, in New Hampshire, which is the closest state without a sales tax. Vermont has been grappling with that since the sales tax has been in existence, and we do have a use tax. So if the law says you are required, if you're purchasing something out of state and bringing it into the state for your use, you are required to pay use tax on that. So obviously not everyone complies, which is why there was about 10 years ago, a form, or part of the personal income tax form got a box added to it to check to either certify that an individual owes no use tax because they did not go to New Hampshire, for example, to buy a fridge, cheaper, less sales tax, or for an individual to say, I have a certain amount of income, and based on my income, I will pay a portion of that because maybe I didn't itemize all of my receipts, et cetera. So there are a few details there where the legislature has acted to try and get at that revenue and to ensure that individuals are complying. In the use tax world as well, you've probably all heard about the Wayfair decision. That is another way that online purchases from out of state have been brought back into Vermont revenues so that those sales are captured. As for the local option tax question, that is set out in statute. Towns collect, or sellers collect and remit to the state for most towns or municipalities. The cities of Burlington and Rutland are two outliers because they had local option tax prior to Act 60, so they administer. There may be one other town that I'm forgetting. But the statute allows the Department of Taxes to retain an administrative fee, and then after that has been sort of scooped off the top, towns get 70%, and then the remaining amount is sent to the pilot fund. Okay, so that was a little legal. Sorry, I feel like very wonky discussion. Okay, so the part that I will be leading you through is how do you actually impose a tax? What is the basic structure of a tax? And why I really enjoy giving this presentation is to give everyone the basic tools and terminology to talk about tax in an informed way. One of my sort of pet peeves when folks talk about high taxes or tax incentives is confounding some of the terms, in particular credit. That is not the only way to give a tax incentive. There are other ways to tweak the structure of a tax. We do, as Emily pointed out, the Joint Fiscal Office does provide, and I'm sorry, I'm legislative counsel, so we are two separate offices, but we all work on tax expenditures in some form or another. Once an expenditure has been enacted into statute, there does have to be an explicit statutory purpose. Emily did touch on that. Additionally, there are many ways to create expenditures, and that's a lot of what this presentation goes through, both expenditures and ways of raising revenue. All of those are policy decisions, and they're all up to you to make. Okay, so the basic structure for a tax, there are three main parts, and I will break them down and give you the different terminology to talk about them in an informed way. You have a tax base, a tax rate, and a tax liability. So here's your very compact computation that can be dissected in many different ways. And that's where you get into all of the different ways of talking about taxes, how you talk about the rate, how you talk about the base, and what happens with the tax liability. So each part of this structure can be modified to reach different policy goals. That could be to change behavior, taxpayer behavior. It could be more of a punitive tax to such as what's called the sin taxes, excise taxes. The cigarette tax is often an example. There is a clear policy decision behind that rate and that tax to try and disincentivize use of that product. When you're looking at the tax base, the bigger the tax base, the lower the rate can be. And I point that out as that is another policy decision that could be made, which is often taken into account when making decisions about tax, is what's the amount of revenue that the state will get. That can also be a reason to change any of these three parts of the tax structure. So a tax base, starting with the modifiers that you can enact. The tax base is defined by statutory language, and then you have any exclusions. So you can call it an exclusion, you can call it an exemption or a deduction. An exemption is an exclusion that is usually limited to a particular group. So it could be this type of use or this type of taxpayer has an exemption. It could also be an item. Emily did mention the sales tax exemptions. There are at this point either 55 or 56 in statute, and those are added and changed every year, every session. Exemptions can run the gamut. They can be a full exemption. For example, churches, public pious and charitable properties, they're given a full exemption from the property tax. They can be partial, they can be limited in time as well. They're not always forever. A deduction is an amount subtracted from the tax base. I have separated these out, but these terms are often used interchangeably. The area where you see deduction used most commonly is with income taxes. And a few policy considerations when defining a tax base is to consider both the cost to the state and also the ease, as Emily mentioned, whether it's simple enough and clear enough for a taxpayer to comply with. And there are actually constitutional requirements in terms of legislative language not being ambiguous or vague because it makes it impossible for anyone to comply. That's in terms of the drafting, but you can also choose to have very clear language that is still very complex and can be confusing for taxpayers. Full exemptions do cost more to the state. Partial exemptions, sometimes some of the considerations behind making an exemption limited is because of the cost. Sometimes it's also to make it more targeted, more specific, and to get at a certain type of behavior. Also to have a certain type of consequence. For example, a few years ago, I think it was 2018, the legislature enacted the Social Security income exemption for individuals with a certain amount of income. All of their Social Security income is exempt. For those over that threshold, only a partial amount is exempt, and then it's what's called phased out, so that after a certain amount of income, there is no exemption allowed. So that is a partial and a full exemption. It's an interesting example and a way that exemptions get very complex very quickly. Deductions and partial exemptions tend to cost less to the state, but they are also less valuable to taxpayers because of that. They're costing less for the state, not necessarily in terms of administration, but in terms of actual foregone revenue. So one example, and again, where deductions are used most commonly is personal income tax. So after the Tax Cuts and Jobs Act, Vermont enacted its own personal income tax deductions. So you have your standard deduction based on filing status. The next part of the determining an individual's amount of tax owed, the next part is the rate. And often folks talk about rate as it's a high rate, it's very expensive, it's a really large tax. As you just saw, the base can be changed greatly. So the rate may seem high, but the tax base may actually be very small. So that's one of the ways that policy decisions can sort of massage how much revenue is being collected and also how much the burden is on a taxpayer. If it's only on, for example, look at sales tax, you're not paying it on groceries. If groceries were subject to tax, then the rate could come down, for example, to raise the same amount of revenue. Not saying that that's a decision anyone needs to make, but that is a policy decision that has been made to exempt groceries. So tax rates can be fixed or tiered. Again, Vermont's sales tax is a fixed rate. Income taxes are the primary example for progressive tiered tax rates. It's usually a series of brackets. So both personal and corporate income tax are structured as progressive tax brackets and rates. They're smooth, more or less smooth from bracket to bracket, and the taxpayer will only pay the assigned rate in each bracket. So I provided a hypothetical. These are not real tax rates, just because it's simple to have, increases of about 10, 5 and 10. So in the most simple example, if the taxpayer had $10,000 of taxable income, their income is entirely within the first bracket. They pay the 5% rate. They owe $500 in taxes. Sorry, it really doesn't like that slide. Okay. With a taxpayer who has $20,000 of income, they're now into a higher tax bracket. They are on the first $10,000 of income paying 5%. On their second $10,000 of income, they're paying 10%. So their total tax liability is $1,500. The $500 that they owe in the first bracket and the $1,000 on the second bracket. So actually, I'll go to the next slide. Some of the terminology here that Emily mentioned I would cover. When you're looking at, go back to, this rate, these rates here, the marginal tax rate is that 20%. You can think of that as the highest tax rate. And often that is the rate that's used to compare income tax rates across states. It's the highest amount. But again, as you just saw, it only applies to the sort of last chunk of income. Whereas the effective tax rate, you can think of it as your average tax rate. So for the individual that's $20,000 of income, because they're paying $500 on the first $10,000 and the 10% on the second $10,000, their effective tax rate is not 10%, it's 7.5%. So this is where credits come in when you're looking at tax liability, because you have sort of this initial tax liability where the tax base has been set, the rate has been set, this is what you owe. However, this is another area that can be modified based on policy decisions. So I've put here minus credits because you're just looking at this initial result of your base times your rate. A credit can be applied to reduce this initial tax liability, and that is an amount that reduces, typically dollar for dollar, the amount of tax owed. It does not reduce the base or the rate. As we saw, the base is reduced by exemptions or deductions, exclusions, and the rate is set. However, it's set in statute, typically a percentage. The final tax liability is the dollar amount that the taxpayer is actually paying. And two terms that are often used, and if any of you work with me and you've requested a tax credit, one of my first questions is going to be, do you want it to be refundable or non-refundable? A refundable credit means that if the taxpayer is eligible for an amount of the credit that exceeds how much tax they owe, they still get the full credit. So if there is $100 of tax liability for an individual taxpayer, but they're eligible for $150 of a refundable credit, they will get that full $150. It will zero out their tax liability and they'll get a $500 payment. Or sorry, $50, add an extra zero. A non-refundable credit will only eliminate the tax liability to the extent that an individual has a credit. So again, if a taxpayer owes $100 and they are eligible for a $150 non-refundable credit, they owe nothing, but they don't get any cash in hand. Some ways to modify non-refundable credits are to carry them forward. So taxpayers can continue to use them in the future. Vermont does not allow any carrybacks, but at the federal level, there are some very complex credits where taxpayers can actually apply them to a prior year's tax liability. Vermont doesn't, to my knowledge, have any carrybacks. And I didn't note here, but again, credits are valuable as policy tools because they can shape taxpayer behavior, because they are worth quite a bit to a taxpayer. They eliminate a certain amount of tax liability. They also tend to be more expensive to the state depending on how they're structured. A refundable credit is typically more expensive for the state than a non-refundable credit. And for personal income tax, there are very few fully refundable credits. One example is the earned income tax credit that is refundable. And Vermont last year changed some of the dependent care credits to make those fully refundable. And that concludes my part of the presentation. I'd be happy to take questions. Again, it's hopefully this makes it a little less opaque. Yes.
I'm wondering if you might be able to talk a little bit more about what makes things more or less expensive for the state when you're talking about refundable credits or credits in themselves. Like, why is a credit more expensive and why is a refundable credit more expensive than a non-refundable credit?
Sure. So if, for example, an individual has only $100 of tax liability, the state just eliminates that tax liability through the credit. It doesn't then also have to pay the additional amount if it was a $150 credit. It's just provides a limit to each individual taxpayer's situation. The earned income tax credit in particular targets lower income taxpayers. So that's one of the policy reasons behind making it refundable, is that the point is to get cash to those individuals. So if you said, well, this isn't a refundable credit, will only eliminate your tax liability, then they might not even have a tax liability through other credits or low income. Yes.
Yes, hi. So I'm from Essex, and we've had you may have heard about the city of Essex Junction that is now the newest city in the state. And the city and the town share a zip code. And so when the city, but not the town, decided to collect a local option sales tax, townspeople who owned businesses, or businesses that were even out of state who were mailing stuff to the same zip code, just started collecting the local option sales tax. Given that there's an administrative fee for collecting and redistributing that, which I get, that's work. What kind of help can the town now get to try to recoup or refund or whatever we can do to get the money that was now being given to the city, but really should never have been collected because the townspeople never voted for this tax,
Right.
yet are being charged the tax.
Mm-hmm.
And it just seems like a messy situation. What kind of help can the town expect?
Sure. So my understanding of when that often occurs is with online sales, where there's a business, someone's ordering something online, it's being delivered to their home address, for example, they're entering a zip code. Those online sellers typically use some sort of software company that does this in every state, and they base their collection on zip codes. So my understanding is that's more of a software / administrative fix. However, for those taxpayers that have been incorrectly charged the 1% local option tax that wasn't owed because they live in the town as opposed to the city, they can request a refund from the seller and then or directly from the Department of Taxes. There is a process in statute when you have overpaid. And I don't want to throw the department under the bus, but they could be contacted to ask for help on that issue.
Thank you.
Are there any other structural questions or policy questions? Yes.
So you spoke about accountants asking their clients how much they spend across the border for non-taxable items.
Mhm.
So what happens when a person just takes the standard deduction? Do we just, or is this more for businesses that go across state? It's really
No, so it is for individuals. If they're going into a jurisdiction that doesn't charge sales tax, or if the sales tax is lower than Vermont sales tax, if they're bringing that item back into the state to use in Vermont, they owe use tax. And there are two different mechanisms. Either the individual could keep all of their receipts. I think it's actually required if it's over $1,000 per transaction. You are required under statute to keep your receipts and then pay that amount of use tax on when you pay your personal income tax. There is an alternative sort of safe harbor table that is based on the individual's adjusted gross income. You pay a small percentage of that if you don't know, if you didn't itemize your receipts, or if your receipts were, under $1,000 and you weren't required to keep them. I don't know off the top of my head what that percentage is. It was changed recently, but it's a fairly small amount. There is also now with Wayfair allowing states to collect from remote sellers. There is a small seller safe harbor where very small sellers don't have to collect on Vermont sales, but most large sellers are collecting. So most Vermonters are already paying when they're buying online. And you can, for example, look at any big online retailer and see sales tax and local option tax is being collected. Yes. Oh, sorry, we're almost out of time. I can take one more question if anyone has. Yes.
Thanks for this. Can you say, or is it fair to say that, just going back to the refundable versus non-refundable credit, is it fair to say that as a policy consideration, it's likely that you would only create a refundable credit if part of the purpose of that credit was to increase the amount of money in hand for those taxpayers?
Yes,
An easy way
that's
to sum
fair.
it up.
Yes, and it's not, and I use the example of the earned income tax credit because it's one I'm familiar with, but there are also other credits. Not sure if any of the business type credits are refundable, but there are lots of different types of credits.
Sorry, lots of different types of refundable credits?
I'm sorry, I can't hear
Lots
you.
of different types of refundable credits?
I won't, sorry, I shouldn't say lots. There are different types. I'm not familiar with every single one, especially for that are targeting businesses, but there are some that are refundable. Okay, thank you all for hanging with us for a whole hour to hear about taxes. And if you have any questions, thank you.